Hey, everybody. Hey, everyone out there on the internet with social media, YouTube, Facebook Live. Just wanted to reach out for today's live stream as we talk about business funding. Um, my name's Lane McGleston. For those who have seen me before on some of these live stream videos, I was asked by Ty, our CEO, to be able to join in here today and talk a little bit about business funding. A couple of kind of home or cleaning things just to make sure I've got things set up in here. I've noticed on my past webinars, if any of you have attended, usually my 2-year-old breaks in about halfway through, or my teenager. So I'm hoping I got all the distractions out of the way. Hopefully my mic and everything's coming in clear here. This is kind of a follow-up live stream or webinar based on one that was done a few weeks ago back in June. I think it was back on Tuesday, June 8th. I did a live stream regarding on funding options that were available if you have poor personal credit. So even if you had poor personal credit, you can still get some funding options available for your business. This one, actually, let me hit over here the present button. So that turns that in here. This is funding business credit options that you can actually receive, even if your business hasn't been established. So kind of the quick overview is, before we get too into depth on going into the details of what those funding options are and their qualification processes, is when it comes to building business credit, I like to break it down into 2 categories. You can get business credit with a personal guarantee, or you can build up business credit without using a personal guarantee. Now, when it comes to business credit or business funding, for the sake of at least this particular webinar, when I'm talking about business credit, this is credit that can be established in kind of either of those 2 categories. If I'm specifically talking about business funding, usually funding falls into the category of a cash or working capital. For an example, a business loan, line of credit, or credit cards, something that you can use however you would like to use for your business overall. Where in cases when it comes to business credit might also fall into the category of vendor accounts and trade accounts. And those are accounts that can be established in your business name, but it is restricted in a way to only what the vendor account or store account would be able to be used. So for the sake of kind of doing some terminology housekeeping for this particular webinar, when you do hear about business credit, typically that's going to be falling under the category of these vendor accounts and trade accounts. Again, you're limited or restricted to just using the accounts that those particular stores or vendors could use, like Home Depot and Walmart. And then when it comes to business funding usually would be more on a cash base or working capital base, so that you can use wherever that's going to be. We'll be talking about both categories. Even in this particular segment, we're just talking about if your business hasn't been established too long. So even if you have a brand new startup company or a company who doesn't have a lot of history, they can still follow up through those particular categories. So hopefully that helps with that kind of home or the initial verification on those different terminologies. Let me change this out. Oh, that's not it. Wrong button. There we go. That way you don't have to look at my face too long, and you can check out what you really came here for, which is that content. Again, Ty Crandall's our CEO. If you do have any questions, here's our contact information, including on the link, which should be going through this PowerPoint presentation. If you're specifically looking for funding, feel free to visit us at creditsuite.com/get funding. I'm Lane McGleston. I've worked with Ty for 10 plus years. I came from the business credit industry and joined Ty when he made his jump from personal credit into business credit. And I haven't looked back. It's a great industry to be in, and either I'm too old and I'm not willing to look for another industry because it requires too much work, or I'm truly actually happily where I am, which is the case. So here we are. We're going to jump right into it. Question that often comes up by a number of clients is they ask the question, why does your time in business matter when it comes to specific funding? For those who it doesn't initially, too many think of the answer to it, here are some of the concerns that come up. Is when your business has been started, you're often considered a startup company or considered a long-term businesses, and then there's everything in between. Why it matters is because when you have to think like a bank. I know I've mentioned this before on other webinars, where if you're a bank and you're someone who's lending capital to a business or to an individual, what you have to do is think of the risk that's involved. A bank's number one question is they're just wondering, are we going to get paid back? So they have a list of criteria that they're working through to be able to determine what level of risk is that particular business or person in. And one of those indicators is time in business. From that previous webinar, before I pause, I think I had one other thing. Let me do this really quick. I copied this link. This is our YouTube link from the video that I did a few weeks ago. That actually went into more depth specifically on funding programs. A number of the funding programs that are going to be highlighted here today were also highlighted in that previous webinar back on June 8th. So today might be more of a quick overview if you are looking to get more in depth on each of these different qualifications or funding options. I included that link right here in the chat, the chat box. So hopefully that's showing up. So you have that up, excuse me, that opportunity as well. You can check that out. Okay. Now with that, I totally forgot I was going to do that at the beginning of the webinar. So business time is one of those criterias that they're looking at. Some of those other criterias are your personal credit scores, if you have collateral, or if you have cash flow, which we'll go over here shortly with the 3 C's. So the businesses often have to demonstrate viability as it's going through these concerns or generalities as well-known product or services for a strong market presence. They have generally reached a point of positive cash flow generation, and they may also be starting to experiment with expanding into tangible markets here. These companies that have been around for about 1 or 2 years, although such businesses can be older or newer depending on their circumstances. So you have to think like a lender, like I mentioned. What's most important to them is basically, will they get paid back? So time in business is one of those metrics to determine what it is that they can determine if you can get funding or not. So in Entrepreneurial Magazine, they recently said that 50% of all businesses, they fail in their first 5 years. And I think when it comes down to it in total time, it's even as high as 90% over the life of the business. So around 30% will survive to their 10th anniversary. Surviving through several years puts your business in basically a category of a rare field of businesses that have actually made it through those initial first years in business. And lenders and credit providers really will prefer that, because those businesses are a lot more likely to stay in business, and also, according to what they're looking for, is pay their debt, which again is what their number one criteria is. So the more time you have in business, presumably you have more cash flow, and you have more likely proper documents, time, and you'll more likely be able to pay off your bills, as well as your business is more likely to have collateral in your accounts as receivables or equipment. So kind of reviewing again, why time in business is so important is because the longer you've been in business, the more likely it will be that you'll still be in business according to the lender. What's one item that's not covered in this webinar that I wanted to pause right here to kind of bring in, and I think I brought it into that previous webinar, is I often get a question in time and business if there is a loophole on how you can get around this time in business. And it often comes down to a shelf corporation. For those who aren't familiar with what a shelf corporation, it's basically the ability where someone has an existing business that's kind of just been put up on the shelf. It's just waiting, being seasoned. And what you can do is take that business down from the shelf, sell the entity to someone, and that time in business transfers to the new owner. On paper, it actually sounds fantastic and sounds great, because you can technically be a brand new startup company, go in and purchase a shelf corporation that's been around for 5 years, officially filed with the Secretary of State, and then inherit that 5 years worth of time in business. Now, here's the pause, and here's the answer to the concern that comes with shelf corporations overall. In the past, and this was prior 2017, 2018, before the great financial kind of downturn or recession, lenders would use time in business as one of their first indicators on being able to provide funding. So if you happen to be in business for 5 years, they basically bumped you up to the top of their list. And that was kind of regardless of generating income or cash flow. So they said, if you've been in business for 5 years, we'll give you a $50,000 business loan simply just based on that information alone, which now that I think about it, it seems pretty dramatic for those lenders to do those things. After 2008, and there was such a turmoil in the markets, what happened is a lot of banks realized that what they were doing wasn't the best underwriting procedures. So they went back and they revisited and they determined what happened with all of these defaults or problems that took place. And they determined that there was a number of businesses that had been established on paper for a number of years, however, never generated any revenue or income overall. So the concern took place is that they were giving out lending options to businesses who technically were startup or who haven't proved themselves. So lenders have tweaked it. They don't look at time in business as big of a number of criteria in comparison to the past. So what they'll do is it's kind of a piece of the puzzle. They'll look at your time in business according to the Secretary of State, but they'll also look at your bank statements. That will be their second verification to determine, is the business actually producing? So this is my personal opinion. Different people will have different opinions. If someone asks, is it worth to buy a shelf corporation to get that length in time? It depends on the price. If you're paying thousands of dollars for a shelf corporation, in my opinion, it's not worth the price just to be able to say you've been established for 5 years, because that 5 years in history is still going to be verified from personal revenue, business revenue, and your personal credit. So it doesn't have the same weight as it did in the past. So I wanted to just throw that in as kind of a bonus material and information before we got in further with the presentation, because that is one of the most commonly asked questions when it comes to time in business. So cool, moving on here. These are the 3 C's, and this is helping you think like a lender. So the 3 C's that a lender is really looking for is they're looking at your cash flow, they're looking at your credit, business and personal, and number 3 is they're looking at collateral. When it comes to personal credit, if you're trying to get a personal loan or a personal bank loan or a line of credit personally, a bank's going to look at all 3. They're going to look at your cash flow, meaning your income, your W-2s, what you're producing on a yearly base based on your job or your 1099 as an employee. They're also going to look at your personal credit, and then they're going to look at your collateral, which would be your mortgage, your car loan, your bank loan. They want to be able to tie the loan in personally somehow to whatever it is you're lending the money on. Business credit's a little different. Business credit, when a lender looks at it, they're looking at the 3 C's, but primarily their approval is going to be based on one. They don't have to include all 3, meaning if you have great personal credit, you can get business funding. If you have good collateral, you can get business funding. Or if you have good cash flow, you can get business funding. And then there's other options that can kind of combine them. But if you happen to have one of those categories, it basically puts you in a better position for business funding. So the more of these C's that you have, the more funding options that are available in that collateral. So every time a business in every stage basically will need money. So based on your circumstances, it might be hard to get off traditional forms of financing, and it might simply be because of these reasons. Number one, you're new to the business, you're a startup. You might be in a high-risk industry. Your personal credit might not be as high as you're hoping, and you don't think you have the collateral. But if you have some time in business, you'll probably have some form of cash flow that you can use, and that helps you with those funding processes. So let's check on those different options. When you first get started, every lender and every bank's going to be looking at your fundability, which we like to call the foundation. I've used this kind of analogy in the past. Imagine that you're in real estate and you're building a house. Before you can truly build the walls, the roof, put in electrical into the house, you really have to have a strong foundation. And that foundation for your business really needs to exist on how your business was established overall. Now, if you have a weak foundation, the lenders are going to be able to recognize it or receive red flags or concern based on that weak foundation. And usually it means that an underwriter has to look into more depth regarding your request for funding. So you might as well create a strong foundation when you start, so then that way there's less of a likelihood of getting an automatic decline from the lender. So some of these fundability items that we're going through on here, they're essential to all points of a lender and the credit providing looking at. They're really trying to figure out if you'll pay back your loan or what credit's been extended to you. So if you haven't included these factors, you probably haven't thought about or might not even be aware of some of them. So here are these fundability factors. Number one is your business name. You want to make sure your business name includes things that aren't necessarily in a high-risk industry. Did you happen to know that it could prevent you from getting funding? To pause for a moment there's restricted industries, and then there's high-risk industries, and then there's industries that are just industries overall. In here, high-risk industries or restricted industries typically fall into the category of things like gun sales or alcohol sales or adult entertainment, those type of, or medical marijuana, all of those kind of industries overall, lenders really stay away from because they're restricted industries. There are other categories that could be like stock trading or real estate investment or personal credit repair that are still considered risky, but they're not restricted. So you can still actually build business credit with a real estate company, personal credit repair company, or even if you're a holding company or trading on the stock market. So there's the clarification between risky industries and restricted industries. A restricted industry, yeah, that's an industry definitely that you're going to have to work around to try to get funding. So you don't have to indicate the name of your industry in your business. So in your business name, it could be a generic name. You don't have to put the industry, but you might consider that if it helps with marketing purposes. So there's nothing deceptive or illegal or otherwise wrong about calling a business Murray's rather than Murray's Real Estate Agency. So yes, if your business name includes the name of a high-risk industry, you should update and change it. And you might as well do it. Now's a better time than ever. Other aspects for your business name, if you change your business name, make sure to update and change it everywhere. The reason why this is really important when it comes to building business credit is the business credit bureaus report information based on your business name and your location. So I know a little on we'll talk about that business location. So if you ever update that information, you want to go through and be uniform across the board with all of the accounts you have so that they will show up with the credit bureaus. Personal credit follows your social security number. So if you use your social security number, regardless of what address you're using, typically it will follow back into your personal credit report. Business credit doesn't necessarily follow your EIN number or your tax identification number. So just because you're using your EIN number doesn't mean it's going to report. So that's why it's important to make sure your name and your address are uniform. I've seen a number of cases where individuals have a misspelling in their name, or they have a different address from an old address, and they'll actually have 2 or 3 different accounts set up with Dun & Bradstreet and Corporate Experian. So they have basically business credit that's spread all over the place rather than just in one single clean location. So that's the importance of making sure everything's updated everywhere. So when you change it among these places, make sure you're changing it with the Secretary of State, your licensing, any credit. This is the credit repair agencies, so Dun & Bradstreet, Corporate Experian, Corporate Equifax, as well as the phone numbers. any of the vendor accounts as well. One little tip to be able to help out, have a master file where you have your business name and the address that you're in, and you can copy and paste that as you're changing the address. That way it can prevent you from having to misspell something accidentally as you're updating and changing these records overall. The other nice thing of having this file is you can have all your different accounts listed like in an Excel spreadsheet, so you can keep track of all the accounts that you have established specifically for your business, and then that way you can kind of keep track of when payments might be occurring, when they're supposed to report as you're going through the process of building up business credit. Other item in Fundability is an NAICS code. Many of you have probably heard of an SIC code, which is a standard index classification code. This is another classification code. This is basically a way that banks can take your industry, assign it a number so that the computers can basically recognize what industry it is. And so what a bank will often do is like, let's say for an example, if you have a nightclub would be a restricted industry. So if you indicate that you're a nightclub, then the SIC code or the NAICS code would be assigned to it, whatever it might be. The bank can pre-program that number so that if that number comes up, then they can automatically have a red flag that says, oh, this is a risky industry based on the number because of the industry, and then throw it in for a manual review or even just throw it out with an automatic decline. So when you're getting started with a business, you want to make sure you pick a good NAICS code or SIC code. I believe, let me actually go through here. I think it actually gives you a website. Oh, sorry, let me hop in here. I think it's on the next slide, a website that you can go. Another website to jot down is siccode.com. That's another website that you can go through, and what you basically do is type in your industry. So if, say, it's real estate, you type in real estate, hit search, and it will give you different codes that kind of fall into that category. So with the NAICS code or SIC codes, make sure you're looking through that list to find one that's less risky in comparison to a restricted industry. One example that I've seen individuals do comes with real estate. Real estate can be considered a risky industry. It's not restricted, just considered risky. So I have noticed a number of business owners, what they've done is they've searched for business development or property management. So if they're dealing with real estate, property management is less of a risky industry than real estate investing, and business management is also less risky than real estate investing. But property management in a way is generic enough that you can indicate that as your SIC code, and the lenders are less likely to just automatically kick it out. Other things, the IRS, the lenders, banks, insurance companies, the credit reporting agency, they all use these SIC code and NAICS codes. They're just trying to determine if your business is in that high risk classification, and it could prevent that quick denial. I believe the other website, let me see, I think it's literally NAICS.com. Oh, I'll have to hop in here to see if that actually pulls it up on here. I believe that is the other website that it comes through in here. If not, I definitely know that siccode.com would fit that category as well to do the search. Another category on this fundability, we're still talking about the foundation on how well your company should be established before funding, is the type of business entity that you establish. So getting financing or credit for your business, you need to make sure you have a business entity. This would be a corporation or an LLC. It basically helps reduce your liability, and it separates you from your business. This is different than like if you're doing as a sole proprietor. A sole proprietor is always going to be attached to your personal credit. So if you are established as a sole proprietor, definitely would recommend considering the LLC or corporation, either S or C Corp, either would be fine. Make sure that this entity is set up in the same state as where you're residing and actually performing business. Your EIN number is your federal tax identification number or your employee identification number. This is important to have So just like your social security number, this EIN number is the number that's attached for your business, especially when it comes to paying taxes. This number is going to be used to open your bank account as well as to establish your business credit profile. And oftentimes it is used for verifying your agencies, the banks, trade, vendors, businesses listed. You just want to make sure you keep it uniform across the board and use that. Your business address. Your business address should be a real brick and mortar business. Place where you can actually have a physical address for deliveries and a place where someone actually resides and work. We recommend not using a post office box address or a UPS store. If they ever Google that address as a lender, they'll be able to indicate that you don't actually work there. One other category to kind of throw in here is during the last year, since a lot of business owners or individuals have started businesses working from home, just on the different lockdowns, we have noticed that lenders have been a little bit more lenient to residential addresses. So if there was like a list of importance or the less risk from low risk to high risk when it comes to businesses, the lowest risk business you could have would be a business address that you physically actually work at. The next level would be a virtual office, which would be a business address where you're renting the address and it's still a physical place where you're at, but you don't have to physically be there. Then it would fall into the category of your residential address that you can still build business credit with. And then the last would be like a post office box where it's a mailing address and you actually don't physically work there at all. So that should help clarify from non-risk to high risk for a business address. Some lenders will actually just automatically decline you based on that criteria as well. Business phone number, a cell phone or a residential phone number that you have for your main business line could get you flagged as unestablished. If you do have a cell phone number, or even if you have a business landline that's coming into your residential phone, the important aspect is to have it in your business name. If it's just under your personal name is really where the issue can come. The voice over IP address is okay as well because that can be listed in your business name with your business address, which is primarily what they're looking for. But it's best not to give personal cell phone or residential phone as a business phone number. It just doesn't look as professional. And also for your privacy, just trying to keep things separate between your business and your personal. Your phone number should and must be listed in 411 for your lenders to be able to get you these approvals. If it's not currently listed, there is a site called listyourself.net, which is a great place where you can actually go and take your business information and get that listed here as well. That way you can check your records to see that your listing and information is listed accurately with the 411 directory. So with the 411 directory, you can actually just call your local. So like say you're in Tampa Bay, Florida, and your area code is 727. You can dial 727-555-1212, or you can dial 411. That will connect you over to your national directory, and then you can ask for your business name through that directory, and they can confirm the address and the phone number for that business. And you want to make sure that that's listed there properly and correct. Another option would be an 800 number, a toll-free number, which can also be listed in that national directory. Business licensing. So make sure you have a proper license for your corporation and make sure that that license is the same on all the documents, like as was mentioned before, as well as with your state, your county, city governments. Make sure everything is uniform. Check the different government agencies to confirm to see if you are required to have a license. More than likely, the type of license that you'll be required to have is an occupational license. If you ever have clients or customers who are coming to your physical location, then normally the city will have an occupational license to make sure that you have fire code, proper things that are set up, Disability Act, all of those type of things are set up properly to be a safe place to do commerce. Now, these licensing does help build your credibility, and oftentimes if you're applying to vendors or store accounts, they'll ask for this verification to help with that credibility. Next is website and email address. if you're in business and you're basically soliciting yourself out to the world for people to purchase your services, what a lender would look for is if you have a way to reach yourself out to the world. And that nowadays, number one, comes in the form of a website. So the more credible you look, you should have a website that you're able to show your services, your product, how to get in contact with you, products that you offer. That website is one indicator for a lender to really determine how credible you are. Make sure you have a professional email address as well. It definitely can help. And it, once again, it just helps you look more credible when it comes to lending option. Boom. Now we're going to jump into, after we finished up that fundability, we're going to talk about different type of credit that you can establish, even if you're a startup company. The number one that you might have heard before, especially if you've been following us here on YouTube or you've been following any of these live stream, is vendor credit. Vendor credit or business credit, kind of going back to that terminology at the beginning of the live stream or of the webinar, this is going to be strictly talking about accounts that are allowing you to have products or services. So again, like a Home Depot, Walmart, a Costco. But these are accounts that can be started even when you have a brand new company. So starter vendors are open to work with most businesses, even startup ventures. They also, many can report back to the business credit reporting agencies. Some of them don't report. They also will give you an indication of like a net terms. A net term account is the amount of days of which you have to pay back your account. And they often will report within 45 to 60 day time frame back to the reporting credit agencies. The nice thing about these vendor accounts is they can help build up these initial reports that need to be showing up with Dun & Bradstreet, Corporate Experian, and Corporate Equifax to be able to help you establish that piece of the puzzle. Here are some of the terms for qualifying. Each of the vendors or each of the stores, you have to think, have their own qualification processes. So this is just a general overview of what many do look for, but there could be specific things that the lenders are looking for overall. So terms may vary. Most of them might do these net 30 accounts. Some, but not all, will look for collateral, good personal credit, or even possible cash flow, back to those 3 C's. But if you do have good cash flow, it can help you. But in some of these vendors, it's not necessarily required. Retail credit, after you build up net turn accounts, there's ways to actually get major retail cards where you can hold a balance. Now, again, these would be accounts specifically for purchasing products and services from these accounts and paying off within whatever their terms indicate. These are major retailers, but anything from office supplies to power tools, retailers can check whether your business information is uniform, as well as they'll also check whether it's properly licensed. Some of the terms and qualifications, again, is individual based on each particular store. So the qualifications can vary. Most will look, though, for your time in business, number of employees, but also looking for that cash flow, basically your annual revenues. Now, as you build up these vendor accounts and retail accounts, different ones have different length and time or have prior business credit reporting. So to just dive in a little about the services of what we do here at Credit Suite is we basically took all the vendors that we're aware of that report to the credit bureau, broke them into 4 different groups based on how easy it is to get approved with those different accounts. So you would start with starter vendor accounts first, because they're the easiest to get approved with. Many of them you might have heard of, like Quill or Uline. Once those accounts are reporting and established, that basically qualifies you to go into step 2 of the program, or 2 of the accounts. These are accounts that are looking for prior history, usually a Paydex score for accounts reporting. Once they're reporting, then you typically have around 8 to 9 reporting, which means you can go into tier 3 or group 3. So you're building upon each group. So the vendor accounts and the retail credit accounts fall within these categories, and they're kind of broken down based on what they're looking for. to get these approvals. Without that kind of initial information, you're kind of just taking a shot in the dark and making a guess based on the vendor and who they report overall. But that gives you a little bit more in depth on the specifics of how to build up these business credit accounts. And they can be revolving when it comes to here. Fleet credit. Fleet credit deals specifically when it comes to purchasing fuel. You don't have to have a trucking industry to be able to get a fleet card. You can actually just be a normal business and they can still issue you free fleet credit. Some of the accounts will want to see a volume of fuel purchases on a month-to-month basis. So if you are a smaller company, you would have to just stay away from those particular vendors and do ones that would still give you approval based on the smaller size of your company. Some of the terms Some of the terms and qualification processes specifically for fleet accounts is they do vary, similar to the store accounts and the retail accounts. They do look for a minimum time in business. Some will offer with the personal guarantee or have you do a secured deposit to be able to get that account established. For those who aren't familiar with a secured, the difference between a secured deposit or a secured account or an unsecured account depends on if you're leaving a deposit with that particular vendor to get it established. In here, there are a number of accounts. What they'll do is have you leave a secure deposit where you'll leave a deposit of $1,000 or $500. That way the account knows that you have money in the process. They'll give you the credit, but if for some reason there's ever a default, they have that deposit there to cover them. Normally, they'll actually give you a certain time limit. I think it's around 6 months to a year, that if you don't have any derogatory items and don't have any late payments and you show good history, that secure deposit would be returned to you and then it would be unsecured at that particular point. After enough business credit is established, you can actually get 2 business credit cards. Now, business credit cards, these are universal type or working capital or funding because you can use them anywhere that you would like. These would be like MasterCard, Visa, American Express. So they can be pretty much everywhere. Many will have reward items in there as well. Some of the terms for qualifying for these accounts is they're the revolving accounts. Usually you have to have, let me pause for a moment here. 97% of the credit cards that are out there will require a personal guarantee. It hasn't always been that in the past. In the past, there was a number of more credit cards that were available that you can get approved for without a personal guarantee. There's still a few that are available nowadays after you build up enough business credit history. So if you do have at least 14 reporting accounts that are reporting on your business credit reporting agency, it is possible to get approved for these type of credit cards without using your personal guarantee. But keep in mind, there isn't very many of those type of accounts left. The majority will look for personal credit overall. Okay, let me see if I didn't miss anything on the credit cards. Most credit cards, they're looking for on your personal side. Actually, I think it's going to go in here. I'll pause on that. I think in the next couple slides, there's a way to get approved for business credit cards when you're piggybacking off of your good personal credit history. So that's going to actually be coming up here in just a moment. The first funding option that can be available for your business is called a merchant cash advance. Now, there are times that are required in these merchant cash advance. The least amount of time is at least 6 months. So you have to be in business for at least 6 months to be able to show bank statements to be able to get approved for this type of funding. Most are looking for 12 months, just as a as to log into your brain of how long in business you should be. So an MCA, technically it's not a loan, rather it's a cash advance based on your credit card sales or the volume that's going through your business checking account. So even small businesses can apply for them. And what they'll do is give you an advance deposit into your account that can be quickly received, and most of them will give you kind of a net term or some way to be able to pay back these merchant cash advance. So a merchant financing program, this could be ideal for business owners who accept credit cards. So if you do have a merchant cash and you're accepting credit cards, that history could be used to be able to get an advance on those sales as a business form of funding overall. They're basically based on your cash flow, based on what your business is producing on that month-to-month basis. Hence, the lenders in general, they aren't going to ask for too many on the documentations or too much on the personal side, because they're looking at your past history for your business is their indication on how well you'll be doing here in the future. Some of the qualifications specifically for these merchant cash advances, I need to update that. That should be at least minimum of 6 months. Most are going to be looking for 12 months. So I should go correct that. So I apologize on that. They're looking for consistent deposits. They also want to see deposit revenue of at least $50,000 per year or more. Usually we see the average on a month-to-month basis that they're looking for is around $10,000 per month or more. Other qualifications for these merchant cash advances, the lenders are also looking to see that you don't have non-sufficient funds showing up in your checking account on your bank statements, and they don't want to see chargebacks taking place from your transactions, and they want to be able to see on a monthly basis that you're doing at least 10 deposits during a month into your checking account. So essentially what they're doing is they're looking at your overall strength of your business checking account and merchant account to determine what the future events are going to be happening for your company as well. So in the case of if you're doing maybe one sale per month and that one sale happens to be $30,000 per month, even though you hit the criteria of the monthly amount, unfortunately, the number of deposits is too light, because a lender is going to look at that, and their concern is if you lose your one client, then basically you're not going to be able to pay your bill back. So they want to be able to see that your spread between a number of clients, a number of customers, so then that way in the case, if you lose a client or two, you'll still be able to pay back this funding that they're giving you. So they also want to look at that decent number of consistent credit card transactions and deposits each month for that very reason. Another funding option out there is auto financing. So oftentimes businesses will need vehicles to be able to use for their business overall. So then that way they can do transportation or whatever it is that their business is facilitating in. So whether a vehicle is purchased, used, new, it can affect the number of years that you can finance the vehicle and the rate that you will pay. So if a vehicle is used, then the number of miles on it will also affect the terms. Plus, business owners may be required to include a personal guarantee. If you have a co-borrower, the loans will more likely report to your personal credit report. And some of these loans can have a prepayment penalty. So you want to make sure you double check what type of loan that you're establishing with these auto financing options to see if they have a prepayment penalty or if they don't. Other items to look at when you're considering getting auto financing is making the following are so in general, the following will eliminate the need to provide a personal guarantee for this type of funding if you have good business credit. So if you have 10 plus vendor accounts reporting on your business reporting agency, then what will happen is there's ways to get auto financing regardless of your personal credit. They'll also look at your time in business or consider your personal credit depending the length and time in business and how much business credit you have established. So much like with any other kind of business borrowing, the more assurances that you give back to the lender, the better they feel and the more likely they will be to give you that loan. So terms and qualifying, these are things that you should have established before applying for auto financing. You want to make sure you have the amount that's as needed as a down payment. You also need to find that vehicle that you'll need, the cost associated with buying that vehicle. Usually the lender is going to look for your business license, any partnership agreement, LLC document, articles of incorporation. If you have ownership of at least 20% stake in the business, they'll want to verify those different owners as well. Other things that most lenders are looking for is they're also looking to provide personal documentation of your personal credit or your credit history. That's if your business credit's not strong enough. You'll also want to look to see that your business entity's been set up as a structure. So if you're a sole proprietor and the business is under your social security number, then they will have you personally guarantee it. Hence, then you're personally liable for repaying that loan It's also a good idea to have a loan proposal. So a loan proposal should detail what your business is doing. It's kind of like your business plan in a way, your loan needs and your financial statements. It just gives them more assurance of what it is that you can overall and be lent to. This is a company that we've used and use currently. It's called Funbox. So what Funbox does, this is a proven cash flow. They're a way to give a small business loan to individuals or businesses based on your cash flow, one of those C's. So Funbox is a terrific. I got to pause there for a moment. I'm trying to get through all the information within an hour, and I think for how many funding options are out there, we'll be right at the cusp at that end. So Fundbox will contact directly. It's through an online accounting software. So you do have to feel comfortable of providing your basically username or a temporary username and password to your accounts so that they can do a verification on your monthly cash flow from your bank statements. And then based on that, they'll be able to turn around and give you a loan based on what they see your revenue and your cash flow is doing. So getting a revolving line of credit, it could be even up as high as $150,000. Again, it depends on how well your cash flow is going through on a month-to-month basis. Funbox will also just do an auto debit for your weekly payment on your bank account, so you don't need to show minimum personal credit scores and you don't need to show minimum time in business. They're primarily looking at how well your company's doing on a month-to-month basis. So although having some time in business makes it far more likely that you'll have good cash flow. So cash flow financing. So a loan made by a company that's backed by a company's expected cash flow is cash flow financing. This is a company's cash flow. It's similar to a merchant cash advance, where a merchant cash advance is looking at the cash flow or your credit card statements. Your cash flow financing is looking at your bank statements for a specific time. So if you don't have a merchant account or you don't accept credit cards, you can still get this funding option available just by using your checking account and that cash flow. And then they'll use that to determine what your payback will be based on what will happening on a monthly basis. So some of the qualifications specifically for this cash flow financing is usually you will need to have some years in business, because they will be looking for at least 6, more likely your last 12-month bank statements to determine what on average you're doing on a month-to-month basis. You'll also need to provide some historical cash flow and present your accounts receivable and account payables to the lenders. And this is what they'll determine what you can get approved for. Merchant lines of credit. Merchant lines of credit, these are often offered by a store similar to the retail stores that we talked about earlier. These credit lines can be only exclusively at that store where they're offered. So for an example, Amazon or Macy's or Sam's Club, you can get different accounts directly with these stores, and they can be issued for purchases from that particular store. Some of their qualifications, again, they can vary. Each vendor account, each store has their own verification or their own qualifications to determine approvals. So it really can determine based on your cash flow, your credit, or the other 3 C's, how well you're doing time in business. So these lines of credit may offer different financing terms during certain period of times for certain products or for certain dollar amounts spent at the store. So in some cases, payments in full must be made in a specific term, like as a net term. Others can be done under a revolving basis, so you can hold a balance from 1 month to the month. Some of the other terms in qualifying for these type of lines of credit are contrast to traditional credit cards and merchant credit cards. This allows the borrower to continue carrying a revolving balance from 1 month to the next in exchange for a shorter repayment period. So the borrower may offer low or even 0% interest or a discount based on those purchases that are taking place. Accounts receivable financing. So an AR or accounts receivable is basically money that is owed to you based on services that have taken place. So if you have an outstanding account receivable, a great example and an easy one to look at this would be like a doctor's office. So a doctor's office performs services. They create accounts receivable either in the form that's being paid by the patient or to like an insurance insurance company. So that account receivable that's due to them, to the insurance company, is something that can be used as a financing option. This can also be in the form of like repair, like a car repair has insurance companies that would be paid to them. Or if you're doing business to business transactions with other businesses, you might send them an invoice on net terms, and that would be an account receivable. You can also have purchase orders, which is very similar, but a purchase order is when you have it's not an invoice, but you have a promise for work to be done in the future. So an account receivable is for work that's been done in the past, that's OU, and a purchase order is basically a quote for future services that you're looking at. And there's ways to do financing on both of those. You don't necessarily need cash flow, but account receivable lines of credit can be 1% with no consumer credit. Some of the terms on this, you could get as an advance up to 90% of the receivable that's owed to you based on those accounts receivable. Normally what happens in these particular cases is there's a lender that will be out there who will look through your accounts receivable, and they'll determine based on who you're billing, and it needs to be business to business, how credible they are. So if it's an insurance company or if it's someone who's really credible, that lender will say, hey, the likelihood of this client being paid is really high. So we're going to give them an advance of what's due to them now, so they have a money immediately now, and basically they're taking in a way ownership of that future payment that's going to come into them from whoever they've been billed. Some of these factor rates can be around 1.33, so it does depend. Some of them could be expensive, but that's another option to consider to look at. So getting an account receivable credit line with rates less than 1% with no consumer credit requirements. Computer leasing, there are a number of companies out there for a business would allow you to do a computer lease. This is leverage on your cash flow to get computers. Like furniture, you can lease computer equipment, and then you can take advantage of these tax incentives as well as use your cash flow to its fullest advantage. So these can be for file services, backup storages, hardware, mainframes, laptops, printers, scanners, things that you're using around the offices. Some of the terms that are involved could be lease to ownership. Often leasing provides businesses with full depreciation or lease of payments against current earnings. A large part of this approval base is on personal credit and your background of the owners, not necessarily on trade or banking information, but how well you're able to get approved as the owner and your personal credit. Boom. And usually the terms are around 24 months to 60 months, depending on who the lender is and the amount that you're looking overall. You can also get business based on business revenue. This is, well, I think this is actually the same terminology. We should have included this in merchant cash advance and cash flow funding, because this is actually very similar. Basically using your revenue for your business to turn around and be able to get financing based on that overall revenue. So we can actually predetermine amount of zip through these terms, since most of it has been covered on there. Okay, this is called the credit card hybrid or credit card stacking program. Earlier within the webinar, I was talking about a way that you can get business credit cards based on your business credit history. This is a particular program where you're piggybacking off of good personal credit history. So what the underwriter or the credit card company is looking for is they're going to be looking for credit scores of around 680, 690 or higher, utilization of around 30% or below, not too many inquiries, but they are looking for length and time and history. So they are looking for credit cards that have been established for at least 3 to 4 years, with primarily, hopefully at least 5,000 or more on a primary account that's reporting on the personal credit. Authorized users can help with your score, but when it comes to get the approval for these credit card approvals, unfortunately, the authorized users don't help on the approval, just giving you a better score. So definitely your primary account will be important. Some of these qualifications, again, yeah, that 680 credit score, no financials are required, and you can usually get around 4 to 5 times the amount in your times the amount of your highest primary credit card. So quick little math, if you have a personal credit card with a 10,000 limit reporting on your personal credit and you apply for this hybrid program or business credit cards, you can normally get around 4 to 5 times the amount of what you have personally. So if you have 10,000 times 4 to 5, so 40 to 50,000 in business credit card approvals. These can be actually really quick, and it can be done with brand new startup companies because they're primarily just looking at your personal credit history to determine that approval. 401k financing, sorry, give you a moment to look through here really quick. These aren't a loan, but this is a way that you can basically take the collateral of your 401k. I'm going to hit the highlights of what this particular program is. So you have to have a self-directed program or 401k. It can't be connected to a contributing business. So if you're currently employed and your business is contributing on a month-to-month basis, unfortunately, it doesn't work on that end. What you can do is through this 401k rollover program, working capital, you can basically use it for business startups programs. This way you can, the number one thing I would say if you're interested in this is talk to your accountant or to your 401k provider to see what type of funding options can be used, because there are classifications of what you can use a 401k for. If not, then there would be penalties. For starting a business, usually that falls under the category that you can use funding from your 401k. And terms, we'll quickly look at those. Those are less than 5% on interest rate. You have to have more than 35% in it. It has to be rollovable within your 401k, and they do look for your 2 most recent 401k statements. And others, 401k financially will speed up. If you have personal credit, cannot use the form of a business where you're currently employed, as it was mentioned, or from an older employer, you cannot currently be contributing to it as well. Okay, quick couple other options without going into too much detail in here. There are other funding options that you might have heard of before called crowdfunding, angel investing, or venture capitalist grants, or even microloans. Again, earlier in the chat, I threw in kind of a link to a webinar that I did a few weeks ago that goes into more detail of these specific options as well. So definitely refer to that as well. It goes over in-depth information here about the SBA program, where you can be able to establish funding for through the Small Business Administration overall. That is a more lengthy process, and you do have to do a number of verifications, but through the SBA program, you can be able to find funding just based on what the government's currently overall doing. Usually the best recommendation is contact your bank representative to see what programs they're able to apply for directly through that SBA program. And I think, oh man, we've got almost all of them in here. Term loans. Term loans are a traditional loan that are able to be established from a bank. Usually 25% on small business loan applications that come their way. Term loans have a lower interest rate than many other funding options. They also have higher loan amounts. So some of these requirements that they're looking at, generally speaking, the company's bank end up having funding very strong financials, near perfect business credit scores. So these would be like the ideal loans that you're getting directly from your bank, but it is depending on your strong financials, personal credit, and they do that personal credit check as well to determine what you can get approved for. But if you are able to get this, these are the best rates by far across the board, and it's usually ones who have been in season the longest in business. So quick recap, looking over here, just as the review, when it comes to business funding or business credit, you want to make sure you focus on that foundation first, that fundability, making sure your company looks and operates the way a company should look and operate across the board, because with that strong foundation, what you're trying to mitigate is basically having banks immediately decline you based on those criterias. So always make sure you're using the same name, phone number, email address across the board so that things are reporting correctly. And then that way you'll have a greater chance of being able to get approvals when you get in front of a lending. So get access to every legitimate, This is just a quick little plug here again for Credit Suite. If you are interested in business funding or business credit, feel free to jot down our number or even our email address or our main website at creditsuite.com. Feel free to, if you go to creditsuite.com, up at the top on the menu bar, there's an option that says business loan. If you click on that link, it actually will give you more detailed information of all the different funding options that were shared here today. So if you have more questions regarding the hybrid program, feel free to go to creditsuite.com, click on business loan, scroll down a little bit, you'll be able to see that funding option and be able to get more detailed information. And if you want to open up a conversation with our funding team, right on that link as well, you can actually get in contact with a funding team member where they can even give you a quote on what they expect you can get approved for. So I sure do appreciate, look at that. 1 hour on the dot. There you go, Ty. I was able to get it through all that information. So hopefully you're having a great vacation. But with any questions, reach out to us. Have a great time. We sure do appreciate your constant patronage and watching here with Credit Suite and the information we provide. It's been fun sharing it with you. I apologize if I went a little too quick. It was just a lot of content to be able to pack into such a short amount of time. Normally, I'd take a moment and run through the comments to go over questions. So I apologize for those who have missed it. But if you want to reach out to us, feel free. My email is Lane. So that's LANE at creditsuite.com. Feel free to reach out to me as well, especially if you'd like a copy of these slide decks. I can get them emailed over here to you. Thanks again. Have a great day and enjoy.